I think really, hopefully for someone out there that really resonated and they're like, whoa, that changed my perspective. Ivan and I have been doing this for a long time. We can both tell you till we're blue in the face that this stuff is really hard and it's not an easy process, and you need to slow way down before you think you're going to, jump in and make a bunch of money in markets. Easy to say, very hard to do. So Ivan, thank you for sharing your wisdom with us here this morning. And before you go, everybody who would like to follow along with Ivan, his channel just got dropped by our producer in the link. So here's his link to his channel. You can also send him a direct message in our Discord chat. If you're a member of our Discord group, send him a message, ask him about his coaching services. He does one-on-one coaching. If that's something that would be beneficial to you, I highly recommend spending some time with Ivan and working through what you're working through in your trading. It will really help to have someone step along with you. So check him out, send him a message. Ivan, thanks for coming on the show.
Thank you very much for having me.
All right. See you, Ivan. Up next, guys, we have Chris Pulver joining the call. I'm going to stick around for just a minute with him and say hello. And then we will be right back with him just after this quick break.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right. Good to see you, Chris. How you doing, man?
What's up, Nick? How are you, man?
I'm good. Chris has been, if you guys are just tuning in for the first time, not seen a session with Chris before, he's been on the show for quite some time with us, sharing insights on markets. And that being said, Chris, we haven't spoken in a minute, and I hope you're doing well, man. But I also wanted to ask you specifically about this recent rally. How much more juice do you think this thing has? I mean, we're almost back towards, believe it or not, back to those all-time highs. I'm pretty shocked by it. What are your thoughts?
Yeah, that's probably the likely destination. I mean, at this point, since we didn't really have much of a pullback after that U.S.-China trade agreement gap, I mean, yes, we pulled back to pretty much test it. We didn't fill it. I am thinking that this market just wants to get to all-time highs. I think that it's disappointing to feel like there was very little opportunity to really participate with a technical pullback, because even running into major resistance around all those moving averages around I'm talking SPX here, like 56, 5700 zone, that US China gap just kind of threw things higher. It's like at that point the bears just kind of gave up.
Yeah.
So all we've seen these last few weeks, it's like price really hasn't gone aggressively higher, but it's like every single day you can notice intraday price action is just trying to melt up. And sitting here watching where we're currently at just over 6,000, that was another kind of round number, had a little resistance off it with the Musk and Trump drama last week. Markets don't seem to care. I think just the easiest thing is going to be, if we just melt up to the highs, okay, fine. I still think a pullback is likely going to happen. I wouldn't be aggressive at all-time highs. I mean, that's just me. So thoughts on that, Nick? I mean, we could clearly go into a melt up, but there's still a lot of things the market's going to have to digest through the summer. This first kind of 90-day pause through tariffs, that'd be in July. Powell, Trump is calling out Powell again for cutting rates. And if more stuff happens with Musk and Trump, who knows? But we don't know, how the negotiations are going for like global tariff conversations. U.S. data, it's all like the same uncertainty is still there. It's just the market just doesn't care anymore. Like right now, it just seems the market just doesn't care. So I'm not upset about watching new highs in the portfolio. I'm not. I'm just I saw some of the posts you had last week. I mean, how aggressive are you right now? At all? I mean, just kind of enjoying the melt up? Are you participating actively? I mean, I've tilted, so I mean, I'm seeing some fresh highs. I talked about this last week. If we go to all-time highs, I'm probably going to see like 275 to 280 in the portfolio, which is fine. But I mean, so I've got some bigger plays. Like actually, uranium's been taking off quite a bit for me. Gold and silver are doing pretty well. Silver's had a nice run last week, so those little like holding trades for me are still like generating some juice, but.
Yeah.
Other than that, it's just kind of, swing trading the indexes and trying to stay out of the way and let this melt up happen.
I'm kind of in the same camp. I've got a long position on the Russell right now, which has gone pretty
Okay.
well.
Yep.
IWM, so I'm long IWM. I've got a big basket of tech stocks that I picked up during the sell-off, so I've done pretty well on that side. I sold covered calls on several names that I have in the portfolio just with this move. I do think we're getting a little bit stretched, but where I see, to your point, Chris, about maybe just making that move back to the all-time high, what I think is fueling it, what I think gives it more juice, is sentiment is still convinced it's the other way, right? We've
Yeah.
seen, looking at the investor sentiment surveys, we've seen persistent kind of negativity around markets. We're still above historical bearish averages at
We are.
41.4%.
Yep.
Then you take a look at the put to call ratio. Put to call ratio has been still on the upper end. Put demand is still very strong out there.
Mhm.
And so, to me, Chris, I think, while I don't necessarily think that we take out all-time highs and then just it's a forever melt up, I think Trump kind of continues to introduce and keep that volatility somewhere in the back pocket all times.
Right.
I do think that this thing can continue to climb that wall of worry that is so clearly still the case for a lot of sentiment out there. One of the things about 2023, I know you did well in 2023, the bounce back after that big fallout year in 2022.
Mhm.
The big bounce back year was, built on just this pessimism around we're going into a recession and all that. So, we may be seeing a repeat event of just climbing that negative sentiment despite the odds. I think what we have behind us now is like, okay, Trump seems to back down every time things get really real when it comes to tariffs.
Yep.
And I think the market takes that as okay, the Trump put is there. And, the Trump put is there. Fed probably wants to cut interest rates this year. Earnings came in pretty good and sentiment is still negative. I feel like that's a recipe for at least a retest of those highs.
I agree. The only potential like flaw of the next like month would be that there's a blackout window for buybacks in these
Mm,
next like 2 to 4 weeks. So that we had like record level buybacks this year, which I think was overall a boon for this little melt up. Like China and U.S. talked apparently last week. They're supposedly in London this week to talk more. So I mean, what we quickly learned after April 9th was this whole idea of tariffing the world is really about the U.S. just trying to rein in China. That's really what it is. And if the U.S. is trying to also get into the metal space or the refined metal space for AI infrastructure, I mean, the one thing that I keep looking at, Nick, is even though this is a melt up to all time highs, we're still way off these lows on Liberation Day yields. Global yields are rising. At some point, it's the rate of change that really shocks the market. So I mean, this like slow, consistent move up in yields is going to be a problem at some point. Like if 10-year yields are up to 5% and
yeah.
crossing fresh highs, like that's a problem. That's where we start to see some of this topping back in.
Yeah.
I was like a little
What are
pullback
your
in
thoughts on
2023.
TLT, Chris? Because I heard you,
I want
I
out
was
of it,
listening.
dude. I
You're
just
out
I
of it?
don't I
Okay.
don't I don't want to hang on to it. I mean, I think
Okay.
that there is a lot of support down here, but honestly, if I had, I mean, I'm still in it, but I'm using a diagonal spread. My break even is like $85. And I'm just gonna actively kind of sell it, like because I'm out till 2027. I mean, I've got plenty of time in the trade, but for every 30 to 45 days, if I'm just selling calls again, it's a diagonal spread trade. So I've got a long dated call option. I'm just selling against it to lower the size of the debit. So I want out of it because I'd rather be in gold or silver or Bitcoin. That's kind of
No-
my whole allocation is like, never mind TLT. I don't want to be in it anymore. Give me the
Yeah.
diversification for gold, silver, Bitcoin. That to me is a better play than TLT.
I mean, Chris, so we can get just into the weeds for just a second on. I don't
Mhm.
want to, it's not the point of the show to get too political, but the whole Elon Musk and Donald Trump fallout did have me thinking this weekend. And to your, that's why I asked about TLT is, you know, politicians, it doesn't matter which way you lean, red or blue, right? In the United States, the challenge that I see and the long-term bull case that I'm a forever bull on gold on the big picture.
Yeah.
And I know you are too, right? The idea though, that the national debt keeps climbing and there is no true incentive. In fact, there's strong disincentives. I don't know if that's a word, but opposite incentives to not cut spending. Like there is no way. And I think Elon Musk kind of had his meltdown and, went to Twitter over realizing that, he may have helped Trump get into the office, but it's not necessarily a Trump thing or a Biden thing or a red thing or a blue thing. It's just that the way Congress works, to keep seats in Congress, you have to administer to your sponsors. Your sponsors want you to keep spending money massively, frivolously. And it's a problem. The whole system is built on never ending government debt rising, spending more money, raise the national debt. It's concerning to me because I'm like, okay, do I really want to park a whole bunch of money in TLT? Well, the thing that I see, Chris, the challenge to all this is we have this national debt rising dramatically in a peacetime. What if we go into a wartime? We also have national debt rising dramatically. And the reason it hasn't blown up, I think, is because GDP growth has been pretty rock solid for the last few years, despite everything. What happens when we lose one of those two stories? What happens when we go into massive, well, hopefully never, but I don't really see this happening. But if we enter in some scary wartime environment and printing money like crazy happens,
Right.
or we lose the GDP statistics. Let's say that grind higher in the 10-year causes just national debt to become so unsustainable that we're using all of our GDP to pay. Like there is a scenario here where I'm like, if it all falls out, I don't want to be in TLT. I want to be in gold.
Correct. Yeah, and think about the scenario where, okay, so this administration, when we first started, was the first real accepted austerity that we've had in the US for a long time. Like when Trump got elected, it was about let's fix the government, right?
Yeah, right.
Get rid of corruption. That's why we have Doge. And you can see the consensus. Like people were supporting the idea that Trump can or Musk can come in and try to cut $2 trillion. That was the plan. They cut a couple $100 billion, and then obviously there's been a huge disconnect now that Musk is like, look, call your congressman, call your senator, get this bill killed. Like this is terrible. It's just going to add, everybody knows it. Everyone knows it's going to add $2.4 trillion to the deficit. And again, red or blue, it doesn't matter because you can go back historically and see for the last 70 years
They all do
that
it.
they've all added deficits. Like in fact, Republicans, believe it or not, everybody, Republicans are worse at adding to the deficit because you've got socialism for the wealthy with the Republican Party. You've got socialism for the poor with Democrats. Democrats are not doing themselves any favor after losing this last election. I don't know if they're doing anything good to get votes back at all. But my point is, so we had supported austerity that quickly pivoted April 7th, right? Once we had Liberation Day on April 2nd, we had the dump on April 7th, and then April 9th was this big pivot. We went from austerity, crossed it off, that's not going to happen anymore, to now there's the Trump put, to now let's go to, we're going to grow our way out of it. We're going to grow our way through it. Nick, we're at 22 times earnings in the S&P. We can't really grow through it at perfect earnings right now. We can't grow through it at these all-time high valuations or these high valuations. So I think the third part of that is, okay, so we don't have austerity. We say we want to grow through it, but we really can't at these levels without having a better correction. We've got to grow from like a 14 times earnings, not a 22 times earnings.
Yeah.
And then the next thing that's left is print your way through it. More like add to the deficit, more money in the system, more liquidity,
which is always and
that's what we've always reverted to. That's all. Ultimately, we have been spending every year like we're in a COVID crisis or great financial crisis type situation. We're just throwing that in the markets.
Yeah.
And I do think that the US has kind of carried the world through COVID and into now. Now the other part of the world is catching up. So like Europe is spending more money, China's spending more money. And that's why you and I've talked about this, but like my bigger concern is like we just go into a global melt up. And the dumbest thing is that the market just keeps going higher. But ultimately, it's still going to give back 30% or 40% or 50% at some point.
Chris, the classic. Yeah, no, I agree with your census there. I mean, that's the worry is that these resets need to almost happen. It's like breathe out, breathe in, and we've talked about this for years together about how the Fed saves every little dip, and well, I mean, I guess it wasn't really the big savior, I guess, in the recent sell-off, but that was kind of a self-inflicted thing with the whole tariffs and then
Totally
no
was.
tariffs.
The Fed was quiet, but that was all Trump, and that was all the Trump pivot. That was
Right.
all the Trump pivot. Yep.
And so, yeah, I mean, I think that's that is where I'm like, okay, I look at that and I say, this is why for traders, investors, most of the time we do these streams. Chris and I have collabed on these streams for a while. And most of the time it's kind of markets grinding higher, but then every once in a while you see how vicious the market can be when it turns down, when you get a VIX that spikes. And I think that we always talk about this, about how when you get to low VIXs, it's very simple, but you probably want to at least be considerate of, okay, another one of these is coming. Like another one of those is going to come at some point or the other. How are you going to deal, not when or not if, but when that happens again? And, you know, Chris, you and I was talking about this earlier on the stream about kind of our situation that we went through in August of last year, and how August for me absolutely was so painful because I gave back so much of my gains due to some really bad slippage on that one. I think it was August 5th.
It was a weekend. It was the SOM rule. So Thursday, Friday, Monday, because that huge, like, futures opened way lower on Sunday and they just bled all Sunday night. And then coming into Monday's open, it was like a 3 to 4% gap lower. And there was, the liquidity was brutal on that day.
And so I was trading the Qs on that day. So of course I didn't get the futures. I couldn't close out of anything in the futures. I was trading Qs. So Qs open up, boom, get stopped out, and market, you know, bounces back. Really painful. But my point is just, you know, for audience listeners, just be considerate when I think the VIX should be on everybody's chart, to be honest, or your watch list. I think everybody should look at the VIX and just say, hey, where are we at? Okay, we're in a relatively calm environment right now. How do I want to just be aware, be present currently, and say, okay, I know I'm not going to stay oblivious to the fact that this won't be here forever. It's going to go back up at some point. It may stay here for a couple of weeks, couple months.
Right.
But how are you just going to be positioned? And I just think that's something we should always be thinking about. It's something I always do think about. But there are those things that I just got done talking to you about, the sentiment stuff, kind of still remaining a little bit cautious. That tells me I think we may have a little bit of room for this to kind of keep squeezing. But we're also coming up, Chris, to the end of those 90-day pause timelines.
I think that's probably the market's next big window is, you know, okay, so let's see, and here's how simple it could be. We get to 90 days, and what's the US going to do? Probably just extend it another 90 days. I mean, I'm serious.
That's how they do the national debt. Why not?
It shows this whole thing was just not planned out at all. It's like, we'll go 90 days and give time to negotiate, and then we'll get to that 90 days. We'll say, well, we'll go another 90 days. We did with China already twice. So I don't see it being like a huge dramatic event. But look, I think right now it's like the whole market just wants Trump to keep his mouth shut, because if he just steps in and blasts Powell more, look, Powell is watching inflation probably more than anything else. This week we have CPI data, PPI data Wednesday, Thursday. The year over year in the headline CPI is expected to go higher, Nick. We printed 2.3 last month for the year over year. Now it's projected 2.5. So we're looking at a 0.2 increase. Does the market take that as a bad thing? I don't think so. I mean, it's like the market earnings were solid. Buybacks were at record highs. You know, Mag 7 was one of the more aggressively rotated out of baskets to rotated right back into it. I think we clearly need Mag 7. We clearly need, you know, a broader market. But I mean, what's leading this year, and this is why I'm not super bullish on these markets right now. It's like what's leading are not typically bullish sectors. What's leading us are utilities, industrials, financials. Those are not tech. Like, that's not tech. I mean, we are a service and tech-based economy, and none of those sectors are leading. And if the argument is, well, it's because we're building out for AI. Well, I don't think we can handle AI. Right now, I don't think we have the infrastructure to handle AI. I don't think that we can handle the displacement if AI truly comes. I mean, you probably saw this in the headlines in the last 30 days. I don't remember the name, but somebody that's high up in the AI space is talking about in like a 1 to 10-year window, which is a big gap, obviously, but AI could come for 90+% of jobs. And the governments aren't ready for that. And in corporate, like, I was having this conversation this weekend, but I don't know what the solution is. If all of a sudden 90% of jobs are replaced by AI, I mean, what do? You're going to have to tax the wealthiest companies that are making 90+% profit margins. You're going to have to tax them an insane amount, like almost as if like they're not going to be profitable, because the government's going to have to tax them 50, 60, 70% in order to make up for the workers that are no longer working. You know, like, is that where we're going? I don't know. And that's like so like rabbit hole negative. It sounds awful, but it seems like we're at this point of like an adapt or die from a human standpoint and from a corporate standpoint. And AI sounds great, but it's like it's the only exciting thing that like Wall Street's grabbing onto. It's like this AI story because it could be so profitable. But if you displace a bunch of workers, and what's always been, everyone's worried about a recession. What's the biggest factor to cause these recessions, Nick?
Unemployment.
Exactly. So what happens when AI is the thing that's taking over and all of a sudden our unemployment jumps from 4.2 to 6, 7, 8, 10%? We have a recession. And that is going to be felt in the markets, and consumption is going to drop because we're still 70+% GDP, or 70% of GDP is consumption. And if you have the wealthiest individuals cutting back on spending, that's going to be the trickle down into everyone's going to feel it. So ultimately, if people keep jobs, the recession can keep humming along. But if we see just a monster uptick, and again, it's like, is this all like self-fulfilling? We want AI, we built to AI. It's an arms race, and everyone's spending as much as they can to have a leg up in AI. But ultimately, what's it do? Just puts a bunch of people out of work, and the country goes in recession anyway. It's like there's no real great solution. It's like either way, something corrective or crisis wise is probably happening. I mean, it's just a typical bear market cycle. I mean, every 2 to 4 years, every 4 to 10 years, like you have these windows. We haven't had a horrible market since 2008. COVID was fixed, and 2022 was a really more of a bond market collapse than it was an equities collapse, but everything was down. And then this year was like a tantrum. This was like I thought it was more systemic. I mean, if you saw the way that price action played out during like April 2nd, 3rd, 5th to the 7th, that felt like very systemic, that like all these countries and all this whole fiat system is tied together.
Yeah.
That was really eye-opening. So that's why I wanted to pivot harder into gold and into silver and into Bitcoin, simply because, look, I don't think we can have a trustful bond market if nobody wants to really flood the markets with our safety net, or it's just the only reason our stock market goes up is because there's more money supply and you're just breaking even, like debasing the currency, money supply, and our stock market goes higher. Meanwhile, if you price in the SPX to gold, it's down. Like gold is stronger than the SPX performance wise. You price it in with the Nasdaq, it's down. You price it in with Bitcoin. It's like those assets are continuing to go up over time. I think those are good to have in the portfolio. So anyway, I mean, the nice thing is with the U.S. markets, with options, you can still generate a lot of income. I am way behind on some of these price appreciation moves. I mean, example, so IWM, I'm still selling calls with a 200 strike.
Yeah.
And IWM is trading at 211 or whatever it is right now. So
Yeah.
but what I'm doing is I can still roll. It's traded at 213. So I'm basically losing $1,300 of appreciation. But because I'm selling calls every couple of weeks and grabbing $150 to $200, after a month, I make up for that gap if price doesn't continue to go sky high.
Yeah.
Tesla, I'm in the same thing. MicroStrategy, same thing. SPY, same thing. And it's certainly not the sexiest way to make income, but it is pretty consistent. And as long as I can keep going out 1 or 2 weeks, 1 or 2 weeks, 1 or 2 weeks,
Well,
I'll
you'll
just
get that
make money, dude.
most likely you'll get that kind of wave down, and that will
For
kind
sure.
of reset you
Like
back to-
Tesla last week, like I went from a rolled covered call in Tesla to that big drop,
Oh
and I
yeah, I'm
was
sure
up
you
like
did. Yeah,
60% of my max profit on the covered
you
call
did well with
within
that.
like a week. So
Yeah, I've got
it's fine.
covered calls on Hood going on right now that I've been,
Oh yeah.
that kind of saved me a little bit. The S&P 500 did not accept Hood into it, so they
Oh, they didn't?
they did not. And
Interesting. Okay.
so I own the stock. I've got good gains on the stock, but I've been selling calls against it. Got
Yep.
a strike price of 75 expiring in 4 days. So this
Okay.
little drop back helps me out a good bit. I'm probably going to roll that up to 85 or 90
Nice.
a month out, and just do what you're doing. Kind of just play that theta decay. If it goes sideways for a month, I'll be nicely in the green. So
Yeah.
on the trade and on the underlying position. So Chris, I'm gonna run. I'm gonna let you take 20-25 minutes, go solo, just
Sure.
get through whatever you'd like to go through. I've been on since 9 a.m. so I'm gonna go take a break, grab some water. Thanks for taking over the show. If anybody would like access to the Pulver alerts, just a heads up, those two are also 45% off right now. If you would like to get trade notifications from myself and or Chris, send us a direct message on our website right now. We'll drop the link to where you can speak to our support team. Boom, there it is. Click a link there. Send us a direct message. Let us know you'd like to join VIP. Chris, you got it from here, man. Nice speaking
All
with
right.
you.
Thanks, Nick. Thanks for hanging out.
See you, man.
See you, dude. All right, I was just looking at Robinhood. So Robinhood's had a big run similar to Palantir. I just saw some comparisons. So I do think this is interesting. So weekly overbought conditions with some divergence, maybe some volatility ahead on Robinhood. One thing that'd be pretty exciting would be if we break these highs. This is a comparison I saw. I don't think this is really going to happen. It's two very different spaces. But Palantir, when we broke these highs, just didn't look back at all. So Palantir was up, 196% higher than the all-time highs. And so now the question is, well, if we did that on Robinhood, is that a thing? Could we break these highs around $85 on Robinhood, and could we go up another 196%? Well, like I said, I think it's in two very different spaces. But I mean, just imagine the surge of $200+ a share on Robinhood. Look, I think that trading is in a very good place. I continue to see that option volume is just growing. If you look at option volume since 2020, your kind of standard like option volume, and then 2020, and now it's just option volume is so big every single day. 50 to 55% of daily transaction is all zero DTE. Um, and obviously there's a mix of traders, there's a mix of gamblers. Zero DTE, just so you know, there is about 10 times more risk in zero DTE. And it's just because of the gamma. All that is like how sensitive pricing can be in options, and how much quicker prices move in your favor or against you. So it's 10 times it's not really 10 times the risk, it's more 10 times the leverage. But as you know, leverage can work for and against you. Look, I do, excuse me, I do a lot of trading every single day. So zero DT is something I've built strategies around. They were core strategies of mine over 40 to 60-day windows, and now I'm taking them down into 0 and 1 day options. And it's still mechanically the same thing. I just get a lot more reps now. So rather than taking 6 to 10 trades a year, I take 200+ trades a year, and potentially have the same reward to risk. So as long as I make sure that my net result is positive, it still works out the same way. I'm paying a lot more in commissions and fees, but fortunately that fee structure for me is not bad. So anyway, long story short is I still think it's a great time to be a trader. I think you're silly to not have protection in your portfolio at this point. As Nick and I were mentioning, I don't think the market is going to get. I mean, I guess the question is like what or why, like what or why would be the reason the market would drop. I mean, you could rattle off a ton of reasons that have been known since April. It's the same myriad of reasons of why this market could turn and fall. Okay, the market doesn't seem to care. Now, technically speaking, I mean, we can zoom in a little bit, um, and I just think this is something to watch, right? So a lot of moving averages, still some pretty good support. I mean, 1 hour trend lines look really, really solid to the upside. The market keeps melting up. I would be watching this, however. Okay, watch this connected lows. You just go from this low right here, right before the U.S.-China trade agreement gap. You can start with these lows, connect the dots. Okay. So if you look from where I connect these levels, you have this low here, this low here, this low here, this low here. So we've had responses to that trend line. Okay. So let's go to these recent highs. Well, if this market decides to just keep melting up higher, 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 can we just connect the dots up here as well? To me, this is a pattern. This is a rising wedge. We have all-time highs sitting right here. Is it possible that we just go chop, 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 poke the all-time highs, and then fade? The one thing that's missing right now from price is that the bears have not taken out any recent lows, right? So as bearish and as cautious as I might be, I'm not bearish rather, but as cautious as I might be, we're not taking out lows, we're not taking out lows, we're not taking out lows. So even though this pullback to me makes a lot of sense, it's not happening yet, right? So it doesn't do me any good to be positioning for a pullback that price is not supporting right now. So all I'm really doing is I'm being patient. I'm still sitting with a lot of cash. I mean, I'm at one. I mean, I'm still around 50% of my portfolio is cash. Now, I've talked about this before. This is what I'm going to do with it. I'm still in, so I've put in some more like core ownership positions. I've gone bigger in Bitcoin. I've gone bigger in gold and silver. Uranium's been a nice little play. I've been in there for the last couple of years. It's starting to take off with this whole shift into like more of a nuclear adoption, like nuclear energy adoption. So URA is doing pretty well. But I'm not chasing really anything. I mean, stocks are up, cool. Indexes are up, cool. Like I'm not chasing. right? What I'm doing is, now that I've established some core positions, I'm using options to generate some income. It's boring, but across the board here, I'm just trying. I'm doing the math here. I would say that across the board, if I do, let me just write my list out here. So the core positions that I'm routinely adding covered calls to, I have SPY, IWM, MicroStrategy. What else? Tesla. That's kind of it. I remove my covered calls on SLV, so that's running like it's just running with no covered calls, so it could be all price appreciation. I think silver has room to take off. Um, I'm still exposed long on gold and silver with no covered calls. Trying to think anything else. That's kind of the big core ones there. So on average, and I'll put this, I'm on like basically 13 accounts. Okay, so 13 accounts all have these core positions. On the SPY, if I can generate about $1 a week, so $100 a week times 13 accounts. Okay, so that's about $1,300 every probably 1 to 2 weeks. I'll be conservative here. I'll just say every couple of weeks. Okay, so $1,300 every 2 weeks. Okay, IWM is a little bit less premium, but I'm getting about $100 every 4 weeks. So I'll say $100. I want to kind of make these out like monthly income. So we'll go $100 every week, 1 week. IWM about $100 every 2 weeks. Okay, MicroStrategy is a lot more lucrative. I can get typically like $250. That's on a low end, upwards of like $5, $250 every 2 weeks. And on Tesla probably about $200 every 2 weeks. Okay, so I'll just add this up. I might as well just space out this and say $200 for every 2 weeks. So I've got $200 on the SPY, $100 on the IWM, $250 on MicroStrategy, $200 on Tesla is 2, 3, 4, 5, 750, right? So equals $750 times 13 accounts equals. Okay, so every couple of weeks, my portfolio just on these core positions alone can generate about $9,700. Okay, so if I do this over a month, I can generate on my portfolio about $19,500 every month. Now, that is if I want to keep the positions and keep them running and keep rolling these calls over and over again. I do think that a pullback eventually will that price. So if my Tesla cover calls at 277.50 and price drops to 250, well, at some point that's like, well, now I'm upside down. Even though I've lowered my cost basis on Tesla down to 240, I'm still in profit on the trade, but I'm just going to keep selling calls. Eventually, I've got to be careful on how much lower I go with my call price because I'll start chewing into some of those profits. But just on sheer option income, this is helping me make some money. This is why my portfolio is up another $17,000 from my recent high. I told traders that if we get to all-time highs, the tilt in my portfolio probably gets me up to like 275 to 280. That's fine. And in the background, uranium's taken off nicely. I'm not in a huge position there, but it's enough to notice. Silver's taken off nicely. That's a big enough position that it is enough to notice. So if I go to uranium, for example, it's up around $11,000. If I go to silver, which I have mostly, there's 3 positions I'm in silver. There is CEF, which is a gold and silver ETF, and CEF is up around $4,700. There's PHYS, which is up around $4,000, and then there's of course SLV, which is up around $29,000. So silver's a pretty good chunk of profit, and I'm not touching it. I'm not going to sell calls. I'm not getting in the way. I think silver has room to run. Meanwhile, these are decent enough premiums to maintain a core position, generate income on. This is a client account that I received about 3 weeks ago. Okay, already up about $2,500 the last couple of weeks by doing something very boring. And I don't care if I did this all year, and this account can generate, let's say, 30 to 40 grand without taking a ton of risk and just selling calls and using the capital as an income-based method to just keep collecting income. So I'm in a stage right now where it's like this year to me is I want to protect the downside and make sure that I'm not overexposed. Okay. I was pretty aggressive in here, as I think a lot of well, under like I'm not going to say I'm a smart trader. Okay. I understand the opportunity when it was presented. I saw the technicals of a previous all-time high getting tested. And I mean, I bought the SPY at 96. That's a pretty good spot. I bought the Qs at 410. That's a pretty good spot. I am not holding them. Okay. Even though I bought the SPY at 496, we had lows at 482. So I bought in like pretty close to the lows. I did not hold these things back up to 599. When we got back to this level here around 570, I started to dump my shares. I thought this was a lot of past support becoming resistance. I thought we just got above the 200 moving average on the daily time frame. That's going to run some resistance. I dumped the shares. The US China trade gap kind of made me mad, just because it was a 3 to 4% gap. And here we are just kind of floating higher. It's fine. I mean, so what am I doing? Well, I sold a chunk of the shares, but what I am keeping, I'm just selling calls against. And my calls are like, I've got a 585 and I've got a 590. And I'm just selling calls, selling calls, selling calls. I get it that price is going up higher, but if I can generate income on it, I will. Okay. So anyway, long story short is what I'm doing right now is not super exciting, but it is consistently generating income. And that's enough to move the needle right now, because what I have is I've got lots of cash at the ready for a pullback. And I do think a pullback inevitably is going to happen. So whether we, grind to all-time highs, I mean, just think about where the pain of the market has been. And we've mentioned this many times during the last couple of months. The pain for traders and investors, and really the pain for institutions right now, is missing out, right? So what's happening in the backgrounds here? Well, retail traders were really smart money in this case, because they've just been conditioned for 15 years. If you buy the dip or things get bad enough, the government steps in, the Fed steps in, and things get fixed, you just buy and hold. You add more, you dollar cost average in, right? And the retail trader looks way smarter than what I think the institutions give them credit for. Granted, the retail trader is way riskier, and the retail trader is terrible at managing risk. But if ultimately the markets are going to go up and go up again and go up again, what institutions are doing is not participating in this at all. And what they've done is they've held here, they weathered this, they're holding here. And I think at this point, I'm curious, like, are they going to add anything that's on the sidelines? Because I feel like they're not going to. We have $7+ trillion in money market funds. I really think it'd be a terrible decision to see $7 trillion come out and say, well, the alternative is put you back into the equities market. At this level, this would be the last spot that I want to buy. I mean, if you look at this from a trader's perspective, this high, I don't want to buy that high. I'm hoping that this market from this level at least responds to some type of pullback. That's it. Seasonality wise, we know this typically happens. You look at your edge finder seasonality, you can see that, typically August, September are pullback months. These window pockets we have, this whole refi pocket we have in the US from like September onwards, these are risks that are still going to be 2025 risks. The Fed at financing rates. I mean, the Fed starts cutting this September. How aggressive do they cut? If they cut at all, I guess we'll find out. I mean, if we see inflation going higher, I think that at this point, it's pretty safe to say that Trump doesn't want Powell to be Fed chair anymore. And coming into 2026, we're going to have a new Fed chair. Jerome Powell's done in May of next year. So whoever that is, it's probably going to be somebody that's going to be willing to cut rates, willing to listen to the president, willing to honestly blur the lines of having an independent Fed to a more of a kind of politically tied Fed. And I don't know if that's a good or bad thing. But I mean, what we don't want to see is we don't want to see higher inflation. Nobody wants to experience or see higher inflation. It's like the hidden tax that's really pissed off everybody for the last 5 years. So if we get to these all-time highs, fine. Technically speaking, I hope there's a pullback, because there's still a lot of technical reasons. I still would look at this entire position and say, best case scenario is that we hit highs and we have some sideways movement, and it offers buyers a chance to say, I'm going to participate in this, and the data looks better to support it. We go to higher highs. Okay. I think a realistic play is that the market gets to these highs, pulls back, and just finds some dips, right? Find this like this is a ridiculously strong support level. Now that the bulls have just like shown, hey, look, we're in control. The bears are absent. I just think that this is a great spot to offer a dip if we get it. And I don't know what the catalyst is to turn it that way. That's the downside. We just don't have like a normal, like, well, the market's just going to pull back. Well, we can't have that, right? Instead, it's like, why is the market down 1%? Why is it down another 3, 4, 5%? It's going to be a bunch of terrible things happening all at once, and the market's down really quickly. But ultimately, it's probably going to be fine. And what would be the trickiest environment would be we get up to these highs, we come all the way back down here, and everyone in retail is buying this dip, and everyone is just going to see another flush lower. And it's not necessarily breaking lows, but it's enough to get down here to these nasty April lows. And it's like, what the heck just happened, right? We just spent months recovering, and here we are giving it all back. I think that would be the trickiest environment to trade. You know, it'd be extremely difficult because everyone feels a lot better about the economy right now, right? Even though bears, and I'm still surprised that bear sentiment is that high. I don't know if if who is surveyed here is just more like politically motivated to say like I'm so bearish. I mean, look, I get it. There's a lot of uncertainty, but the economy is showing resiliency. Unemployment still historically low. And until those start to tick up, like this whole idea of having a recession or at least having like a full on everybody feels a recession, I don't think is the case. I think certain sectors can feel it. I think the consumer can feel it. I think Main Street is feeling, recession ish. And that's why sentiment is so bad. But Wall Street shows us price action wise is something very different. So I think that my plan is if we get pullbacks in here, I will be taking option trades that allow me to stay out of the way. I can still make money in this environment here. If prices go back up again, cool, I'll participate. If prices stay sideways again, and maybe we have a range level or like a higher low but lower highs, I don't know. I will say this: if the market goes and just melts up, if we're at 650, if we're at 650 SPY to 700 SPY, depending on how that looks, I've got to be ready for some type of correction. Even if we pull back here again, we're going to have a correction. And my concern is that it becomes that type of correction. That to me is a bigger concern, right? Is that we hit these levels, we connect these dots, and it's just a classic broadening pattern, but nobody's really ready for the market to make. Okay, so we went here, we pulled back, we went here, we pulled back, we go up here again, everyone's all excited, but then we pull back if we make a fresh low. Right? It's just bull traps and bear traps. So we did that in 2018, 19, 20, 21 to 22. Like that was how this market played out for almost 4 years. And once we got through the bear market 2022 up to some highs, and it kind of blew through that pattern. But it does have the ability to kind of set the framework of like excuse me, painful trades up or down. So I'm not overcommitted to the upside. I think this market is very determined to get to the upside. I think if you're going to have a bias right now, it just has to be conservative, but like hinted or slightly tilted towards the bullish trade. Once we get to these highs, then okay, what's next? Is it just all positive news? Like I said, there's going to be a blackout window for buybacks. Maybe that pauses the market a little bit after this earnings season. We get into this, there's going to be a brief holiday window through July. Then there's the 90-day pause. What's the result of like having this first 90-day tariff window pause? I don't know. Maybe we kick it down the road another 90 days. Does the market like that or hate that? I don't know. I mean, I think the market won't mind because all it shows is we're still just trying to negotiate with countries. But it just depends on how it's rolled out, So I don't know. I mean, honestly, the last couple of weeks, I've just grown a little bit more frustrated with like, yeah, I get it. Like, I'm just gonna have the markets benefit from, or I'll benefit if the markets higher. That's fine. But I don't feel a lot of conviction at participating at fresh highs. I'm same thing. And again, call me, call me overly patient, but I still think there's a reason I'm going to wait for gold to pull back. Right? I mean, one thing that would be I think a great trade in gold, and Nick talked about this earlier in the year, is maybe something that gets me back to the correction that I want. I want this correction back down to the 144 200 moving average in gold. We're now stretched over 400 bars. If we end up breaking here in gold and going higher, we'll have a little bit of an asset bubble here in gold. It might run to 3,800, might run to 4,000. I think from that point, something's going to be like the bond market breaks, the dollar breaks, something happens where it's going to be like wild and crazy moves. Everyone's going to be excited up here only to face a really nasty correction coming later, So gold just kind of staying sideways. It's actually a good thing, because to me, this is just a healthy bull market that's showing consolidation, and it allows bulls to still accumulate here. And once we go higher, great. It's a healthy bull market. The one thing I didn't want to see was what everyone was like, bullish gold, bull. It's like once you're here and it's just stretching further and further and further away, give me a chart. Okay? Give me a chart that's stretched away from all these moving averages and that keeps going without eventually crashing. There's not a chart that just keeps going and going and going and going. There's not. So this is a good thing. So for everyone that's just impatient now with gold because it's going sideways, it's okay. Wait it out. This market will give us an opportunity to, one, either consolidate and let these averages catch up and we can accumulate some more here, and then we'll see a nice healthy run higher. Meanwhile, we've seen silver take off, right? Silver compared to gold is working way better, right? Silver is way better right now, and I love it. And I have been saying this. I am liking silver better than gold from a technical standpoint. It is a lot cheaper to trade. I can measure my highs. I can measure my swing trades. I can measure my symmetries. And I mean, I could see silver going to, $40 and change, $41 and change. And honestly, all-time highs are all the way up to $48 to $49. Okay. So if I said nothing other than, look, silver has room to run another 30% higher, I'm pretty excited about that trade. If silver pulls back, knowing that this is a potential target, look, a pullback into this level here, a pullback into this level here would all be dynamically supported. So if it just stays in a trend and we make higher lows and higher lows and higher lows and higher lows and higher lows, if we're making higher lows and higher highs, that's a trend. There's a lot of ways to participate in this market. Okay. So I still think silver is great. Bitcoin pulled back briefly. We pulled back into this first little inefficiency around lows at 100,000. Bitcoin is probably going to perform well. Like, I thought we'd have like an opportunistic pullback in here, thinking we could pull back maybe to like 98. Didn't quite get there yet. The question is this it? Is this an overbought condition with divergence that pulls back from, highs at 112 back to 100? It's a little tiny pullback, right? That is about a 10% correction. Okay. Is that it? 10% correction on Bitcoin and we're going to all-time highs again? Maybe. Okay. We'll find out. But I think it's more unlikely that Bitcoin comes all the way back to these lows. Unless the market's going to have an aggressive pullback, I think that Bitcoin is just going to keep offering really this alternative that is getting better and better every single day. I think there's more and more compelling conviction behind Bitcoin. I think there's more mainstream adoption to Bitcoin. There's obviously more securitization of Bitcoin. When you look, if you have a retirement portfolio and you can now allocate 1% of Bitcoin, you can allocate 3 to 5%. You can choose whatever you want, obviously. But even for most of financial advisors to offer some type of Bitcoin exposure, I think that's a good thing. I really do. And what does this represent? Bitcoin represents the potential hedge against the entire fiat system. And I think in 2025, that's probably as obvious of a trade as I could imagine in the last, 6, 7, 8 years when it was like being discussed is, if the fiat system, it's a big Ponzi scheme and blah, blah. True. But what we're seeing with the manipulation in the bond market and the dollar being down, it's 9%. The dollar itself is down 9%. Worst start since 1990. Okay. If all we're going to do is we say austerity, but it's not austerity, we say growth, but it's not real growth, we print. Hedging that system is Bitcoin, in my opinion. And I'm not saying that Bitcoin is immune. I'm not saying that it doesn't have any problems. It's going to have volatility. We're going to have some pullbacks. Obviously, there could be all sorts of weird competition where it's like, the not your crypto, not your keys, or not your keys, not your cheese type thing. Like, I get it. There's protective ways you want to make sure like you don't have your money touched or your Bitcoin touched, and that's a whole nother conversation. But I think it's a hedge from a system that probably is going to have to run parallel. I think if Bitcoin can offer a appreciating savings account, while your checking account can be the indexes, your checking account can be the fiat system that's just meant to be printed and funded, and it's like the world is greased by dollars, but the world can be appreciating from something like gold and Bitcoin and other assets that are just not you can't print to oblivion. You can't keep the 21 million Bitcoin in circulation. That's it. Like once we hit 21 million, that's it. I hope. But instead, it's going to be, okay, if we got 21 million, they got Bitcoin and they got layers and layers and layers of Bitcoin, because that's what the system is, right? You've got, I think global assets, if I'm not mistaken, is like $100 trillion in total global assets. But there's like $400 to $500 trillion worth of derivatives and leverage. And that's a lot, that's a lot of leverage that at some point goes away, at some point comes crashing down. But that's all the doom and gloom stuff that I'm not going to sit here and predict. I think that if you are a perma bear, or how easy it is to get caught up in the hype of how scary things are, you're just making terrible decisions and stick your head in the sand and hoping that the market, I mean, if you're trading to be a bear, you're an idiot, because all this market has done for the last 70 years has gone through up, everything has gone up. It pulls back. Yes, it has corrections, but this is the most resilient instrument I have ever seen is the S&P 500. Like, this market has gone up through everything. And this is no different, right? Self-inflicted trade war in recessions, quantitative easing, tightening, war. It's like it just somehow the markets don't care. What the market ultimately cares about is, are companies making money? Are they making more money? Are they positive, optimistic about the future? And if so, and if interest rates are able to allow companies to grow, then things go higher. We could have, like, the lost decade. I mean, 2000 to 2009 was a lost decade, essentially. If you looked at the dot-com bubble, it was a ridiculous melt up into the 2000 crash, and then it came all the way back down, spent years and years and years getting back to highs, came all the way back down, and then ended up breaking out. It took about 13 to 14 years to get through that window, but it wasn't like you didn't have opportunities. Individual stocks were like non-existent. You had stocks that went belly up and were delisted, but you had indexes that just survived. And yeah, you had a 50+% pullback, but the market is what? Hundreds and hundreds and hundreds and hundreds and hundreds of percent higher from that 2009. 2009's low to the 2000 to 2008 high. I mean, we're way above that now. So anyway, I don't know. You just can't be cynical, man. You can't be cynical. You can't be like, I can be skeptical all day long, but I realize that the game that I'm playing is, for the most part, you got to stay bullish. You got to be bullish. You've got to have protection, and I'm willing to pay that extra, 1, 2, 3% a year in sacrificing some of my upside in order to make sure that I don't blow anything up on the downside. Okay, because also, there is never a guarantee that this market has to stop at a said percent. The market pulled back 10%, buy the dip. It can go back 20, it can go 30, it can go 40, it can go 50. Like, that's the scary part, is how bad does it get? And I think that's where the retail crowd is going to feel like they got burnt the worst, is, let's say the market does hit these highs, right? And then the market does pull back to these levels I'm talking about. It pulls back right here. Well, look, I want to take some positions here, but you know what? You want to know what's scary? It's the same thing that was scary right here. It wasn't the first pullback that scared everybody. It was this. It was that next leg lower. So if we went from a high, low, lower, high, lower, low, that's where it gets worse, right? If we had another move like that, where it's like that second wave, and I guess it'd be that third wave, fifth wave, that's when the retail crowd they go all in here and then just sit in a drawdown. They go all in here and they sit in a drawdown. That's where it gets really painful, right? And so if you think about the pain trade this year, retail's been rewarded really, really well. A lot of them recovered. Passive investors are essentially sitting here saying, hey, look, the market's up this year. Financial advisors haven't had to do anything. If you just sat tight and just said, look, this is noise, we'll get through it, where you at? Well, you're up a couple percent this year. Your 60-40 portfolio is kind of garbage. We did it in this session, right? Did I not take like $100,000 portfolio? And I said, look, if I did SPY, QQQ, gold, silver, Bitcoin, I mean, it was up like 13 or 14%, while the S&P's up like 1, So there are ways to be just simply making money in these markets, but I want to have more downside protection just in case, And so if I can, squeak out 25 to 30+% gains this year, that's great. But I will be protecting a lot through the year. Like right now, I still have hedges into August, October, and December, just in case. We go into the volatility index. I don't think that I think we could all agree here. There's no way that volatility is going to be this way for the rest of the year. There's going to be something. right? There's going to be something. There's going to be something. There's going to be something. These are the scary times. Is it going to be that again? I would hope not. Okay, I think we know the agenda right now. But I mean, we could sit here and rattle off, I feel like 10 to 15 reasons on why the market could or should or will drop. Eventually, maybe that little perfect storm brews and it does all it proves right. It could also be none of them. You know, I mean, I still wonder. Okay, this big beautiful bill, is this going to get passed? Has Musk garnered up enough like noise in Twitter land that people are actually questioning what this big beautiful bill is all about? Or is it you can't stop Congress and House passes 215 to 214, Senate's going to pass it because it's majority Republican anyway? Maybe they do. And I think, look, senators want to stay in power and representatives want to stay in power. So what do? They pass this bill. Why? Because their fear is I won't keep my seat in the midterm in next November. So they'll vote to stay in their seat rather than vote for probably what is right. I don't think that adding $2.4 trillion to the deficit is good, right? That being said, it's like, is it an investment to actually grow to the point where, okay, if we add 2.4 trillion to the deficit, are we making 3, 4, 5 trillion dollars in revenue? Maybe. And then maybe you can justify it. But we've never done that. We operate at a deficit, and the deficit just keeps staying consistently higher, like we have like crisis level spending. So anyway, I think that it's opened a lot of people's eyes to how quickly irresponsible the government really is. If you don't believe me, the U.S. government has pulled in over 60% more tax revenue in the last decade, and we've spent 90% of it, or 90% more. So we're still operating a deficit despite having higher tax revenues for the last decade. So we just like the economy is hooked like junkies. It's hooked on cheap money. It's hooked on spending. It's hooked on having debt in the system and having money supply grow. And I mean, at some point there's going to have to be like a great accounting reset, maybe some fiscal reset. Nothing's going to necessarily break. I really believe that. I don't think anything necessarily breaks. But ultimately, what is going to be stretched and stressed is going to have to get fixed. And nothing forces fix like a crisis. I mean, seriously, think about it. Like, if the markets right now just hum along to the upside, there's no crisis to fix. Why would the government pivot to austerity when we're right back up to just a couple percent away from all-time highs? And I mean, if the bond market, this would be the fix for the bond market. If the bond market has a type of move where, like right now, if the bond market just goes nowhere and it just goes sideways, okay, fine. So bonds are stable. You collect your 3.9%, maybe lower the portfolio volatility. But if we have a falling, like breaking lows, this is a 4-year downturn in the bond market, and we still break those lows. I don't know what savvy investor is going to say, man, bonds are such a good, it's like they are a good deal, but what's going to cause this in the bond market? A bunch of risk off trading, So I don't know. I just don't want to be left being a bag holder with something that maybe breaks the lows. We've tested lows many times. There's no such thing as like triple and quadruple bottom. So unless this is a falling wedge in the bond market and this thing starts to take off higher, what makes that happen? Well, if global yields are rising, it's going to still suppress bond prices. So either global yields start to take a huge downturn, or we have a risk-off event that causes bonds to surge, and then yields can finally drop. And that's the bond market. But meanwhile, what's it do to equities? I don't know. Cause some more volatility. There's your spike in the VIX. Maybe it's a bond-related event. So it's a lot. It's a lot of guessing, and that's not trading. Okay. All I'm trying to do trading-wise is safely generate income. Right now, my certainty is I know that I can keep selling covered calls. I can keep pruning my portfolio, taking my income plays as I see them, have a lot of cash at the ready because I want the opportunity. I want an opportunity to deploy that cash when I think it's good to buy something as opposed to chasing highs. Hood is up, Palantir's up, Carvana is up. It's like, yeah, I get it. That's not how I trade. I can make just as good of returns, safer with a lot less volatility by just trading a lot of options on some core positions, using my capital to invest, and generate returns on that. But pretty diversified, honestly. I mean, between gold, silver, Bitcoin, I've got Japanese yen exposure, I've got uranium exposure, I trade the indexes, I trade some core positions. I'm pretty tight on a lot of stocks. I have some income trades with some scanners that I'm running right now. So, I mean, there's always something going on, but I mean, a lot of it's just a trade is a trade, and then understand your core strategies that help you make money. And what's kind of nice is even if the market goes to all-time highs, even if the market pulls back 5, 10, 15, 20%, I'm still going to be here trading, and I'll still be here doing my best to make some income. So anyway, all right. I think I'll wrap it up for my segment there. Platinum, no, I don't have any platinum. So Tasty doesn't do platinum on the futures market, so I'm not in platinum. Maybe doing like a if there's a platinum ETF. So platinum. So yeah, PL's platinum futures. Maybe this one like physical platinum shares. So PPLT. Son of a biscuit. Well, never mind. Yeah, I mean, that would have been the trade. I mean, I've been staring at platinum for the last like 12 months, like realizing I like the support level. If you look at platinum futures, which is here, okay, platinum futures, I've got this yellow box. I'm like, yeah, this is a good spot to look to get long. And PPLT is right there. So, I mean, a buy-in, you had a chance to buy in like literally mid-April in the low 80s, and now it's up, $25. So at this point, I don't think I need to chase platinum. I think that this is also a rotation into, what has value that can actually keep it. Like platinum is an expensive metal, right? Gold is an expensive metal. Silver is more of an industrial metal, but gold and silver ratio is always pretty reliable. I'd trade palladium or coffee, or I mean, that's if you want to dabble in the future stuff, you got to get in those spaces. I'm not. My gold is oil, gold, silver, futures, and index futures. That's pretty much it. It's fine. I mean, I don't need to trade 20 different futures markets. I can, but I don't. So, but yeah, I missed it. Like the trade on platinum is gone. I mean, PPLT would have been the way I traded it. Would have been in the low 80s. I looked at it to sell puts on PPLT. They just didn't offer anything. If I look at puts on PPLT, okay, PPLT, try to trade this thing, go at 190 days, put in a strike here in the 80s. I mean, you see how this just dies off? Like if you're not selling like a 10 delta, it's like, okay, so I put in, I make $100 on an $85 instrument. So I put in an 80 or 85, an 85 strike. Well, if it comes back to me, then I can take some shares. Like I don't mind this, but I don't think that's, to me at this point, like it's not a good allocation of capital. I mean, if it runs, it runs, but silver's running, gold is looking fine for consolidation. I don't need to chase. Right? Yeah, broader metals market, I agree. So the broader commodity market, the broader metals market is doing pretty well, and I think that's fine. But also if you're like heavy in gold comes with like 25 to 50% drawdowns. So be careful what you wish for. Thinking like gold is just this perfect instrument. It's not. Like it has periods where nothing happens. It has years of consolidation, but it also goes off and does pretty well too. Just had another trade close out for my scanner. Sweet. It's a nice little 50% winner. Okay, let me get that updated. So, all right, I'll let you go there. So I'll be back tomorrow. I'm not going to be on Wednesday. Unfortunately, I've got a conflict during my segment on Wednesday. But back tomorrow, Thursday, Friday for more of my segment here with A1 Trading. And let's just continue to grind this week. Just be mindful of this. We do have news on Wednesday, Thursday. Here is Wednesday's data. So core CPI year over year and headline CPI year over year. The one thing I'm watching the closest would be this. Year over year headline CPI. Previous was 2.3 and the forecast in 2.5. Okay, core CPI previous was 2.8. Now it's forecasted 2.9. So is this the market just saying like, yeah, it's fine, inflation's fine, it's going higher, or is this like the market's not going to like it? Well, I don't know. We'll find out Wednesday. And also we have a PPI on Thursday. So watch those year over years. Okay, I'll let you go. Thanks for being with us today. We'll see you this week. Thanks. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.